I am Rahana Farrell, CEO of 100 Women in Finance, and I'm so thrilled to be introducing this webinar hosted by NAV Fund Services. Thank you all for joining us for what promises to be an interesting and informative conversation. Events like this come together thanks to our hardworking team at 100 Women in Finance, as well as our dedicated global volunteer network, more than 600 strong across 33 locations around the world. Collectively, they hosted over 250 in-person events last year, as well as many more virtual ones like this. 100 Women in Finance is a powerful global community committed to making finance a true meritocracy. We connect professionals to each other, as well as timely and relevant expert content like today's conversation. We could not do our work without corporate partners like NAV Fund Services. We are so proud to partner with them, given their commitment to fostering inclusive cultures across their global franchise. We are deeply grateful to their ongoing commitment to our work, and especially emerging managers. So whether this is your first 100 Women in Finance event or you are a veteran of our organization, I hope you will enjoy today's conversation. With that, I would like to turn it over to 100 Women in Finance Fund Women volunteer Maureen Hart to introduce today's esteemed panel. Thank you for your leadership in curating today's conversation, Maureen.
Thank you everyone for being here today. And thank you to Rihanna for the kind introduction. I'm Maureen Hart, 100 Women in Finance volunteer, and I'm pleased to be moderating today's panel on guiding emerging managers through the early days of setting up a fund and aligning with the best partners through both the investment and operational due diligence processes. I'd like to start by having our panelists introduce themselves and the order in which we'll be speaking today. So, Asim, would you mind kicking off?
Happy to do so, Maureen. Thank you very much for having me. Asim Ghaffar with AG Capital. We are a Boston, Massachusetts-based discretionary global macro strategy. We have about $230 million of assets under management. So based on sort of the investment consultant definition of an emerging manager, with anywhere from under 500 million up to $1 billion, we fit in that emerging realm, even though we have a 11-year track record.
Great. Next, Sumit.
Thank you, Maureen. Hi, everyone. Very nice to meet you. My name is Sumit. I work with NAV Fund Services. My role is Vice President, Fund Accounting Department. NAV is a leading provider of fund administration solution to all kinds of fund managers, including emerging managers. We've been around for more than 30 years. The company was set up in 1991. Currently, we administer about $350 billion in assets under administration. We are a global company headquartered in Chicago. We have presence across the globe, including India, Cayman Islands, Singapore, Australia, Ireland, and a few other jurisdictions. I've been with NAV for almost 14 years now. My role includes client relationship management, client onboarding. I work with all kinds of managers. My focus area is more on the digital asset side, but I do speak with managers that have other strategies, including long short equity, private equity, venture capital, real estate, fund of funds. The way I define emerging managers, although, of course, we can put that into an AUM bucket, but I would like to think it beyond AUM. So the way we kind of tend to define emerging manager is somebody who is starting with their first fund or maybe second fund. They have less experience on handling the funds. Usually they have a shorter track record, typically, let's say 3 to 5 years. A smaller team size, they have about 5 to 10 employees, and on the investor base, they rely more on friends and family, high net worth individuals, and they don't have much exposure to the institutional investor base. If I were to put it in the AUM bucket, I would say somebody who's managing less than $100 million, I would keep them as emerging managers.
Thank you for that. Next up is Tracy.
Thank you, Maureen. Hello, everyone. My name is Tracy Chow. I'm the Vice President and the Team Lead of Manager Research of Exponents. Exponents is a multi-strategy investment firm. We focus on active global equities, systematic global equities, fixed income, and alternatives. So our active global equity businesses is essentially the emerging manager investment platform. We focus on primarily focus on non-US and global boutique managers and in public equity area. Investing in emerging manager is a central part of our investment process. We believe small entrepreneurial managers have a performance edge, particularly in the capacity constrained strategies. Now, the challenge with this approach is that you have to spend a lot of time to evaluate the manager's business and infrastructure because those risks are heightened with smaller managers. Now, at Exponents, we have incredibly in-depth sourcing and evaluation process. I know later we'll talk about more details when we get there. Now, to answer the other question about how we define emerging manager, like what Sami just mentioned, the industry has a commonly used threshold, which is $2 billion US dollars from AUM. However, we believe that number should be customized to reflect some factors. For example, strategy capacity. For international small cap manager, maybe 2 billion would be appropriate size to consider closing the fund. However, for a global large cap growth manager, the number should be higher. So we need to consider some other factors and the scenarios to determine a emerging manager. Thank you.
Thank you, Tracy. And finally, last up is Admas.
Thanks, Maureen. My name is Admas Miskina. I'm a partner and senior ODD analyst at Allborn Partners. I'm based in Toronto, and I lead one of our North American ODD teams. I've been with the firm now for over 10 years. Allborn is a proudly independent owned and non-discretionary investment consultant. We specialize in alternative assets. We've been around now for over 30 years, and we currently have around 350 plus clients worldwide that have over 750 billion in alternative assets invested. We define new and emerging manager opportunities. NEMO, as we label it, are funds that are under 2 years old, and emerging funds are ones that are less than 5 years old with less than $1 billion in AUM. And I can just also add to that 50% of our ODD coverage here is on funds less than $1 billion in AUM. Thank you.
Great, thank you for that. All right, so to start today's panel, we're going to have Austin come back on screen. He's going to share with us his really unique story of how he launched his own fund back in 2024 in a more non-traditional way than what we usually hear today. In 11 years, AG Capital has grown their global macro fund from $500,000 to $230 million in AUM. Awesome, let's start at the very beginning. You came up with a rather conservative timeline on how you were going to define your success in the build out of your fund. Was what you had defined, did that come to fruition? Was it accurate? Were there surprises and bumps along the way?
Great question. Thanks, Maureen. Yeah, so I, excuse me, normally when you think about a fund launch, oftentimes an aspiring hedge fund manager will say, well, I have a 2 to 3 year outlook and I've given myself enough runway to meet that, and then we'll see if things pick up from there and I can raise AUM. I actually gave myself more of a 10-year horizon and had put about 5 or 6 years of expenses in the bank. And so, why did I think of that, and why did I think I needed so much time? Well, for one, I was a little bit older when I started my business. I was 38 years old when I launched my business, and I also launched it with a very small amount of AUM, with only $500,000. So I knew that it would take me at least 3 or 4 years just to get on the map of allocators, for people to think that the business would survive at some level and not just disappear. So the first 5 years I spent grinding the AUM and meeting people and building the AUM from 500,000 up to, call it 10, 15 million, and establish that 4 or 5 year track record. And I thought I would need another 5 years roughly to scale the business, to add good vendors like NAV, who we use for our fund admin and for our separate account middle office procedures, and also to build a team. So it was just me alone for the first 5 years. And then I was able to hire and build out a team of 3 more people to cover operations, marketing, research, et cetera. So now we're a 4-person team, but it basically went according to timeline. It took a good 10 years to get to where I thought it would take. And it kind of did go according to my timeline.
So once things started rolling, I think all of our listeners will know the biggest challenges for a new fund is getting those initial investors. You didn't come out of a pod shop or a larger fund. You came from a consultant. So what was your approach to getting meetings and seeing those turn into investments? How did you gain that trust?
Yeah, great question. So normally, as everyone knows, most hedge fund launches start with either a large ticket from a famous hedge fund manager where the individual spins out with a starting check for maybe 100 million plus some other commitments, or maybe they worked at a bank trading desk at a Goldman Sachs sales and trading role, and they start with a few $100 million. That's your typical launch. We're sort of a unique story where I didn't have that. My career was spent at a variety of Boston-based consulting firms. My longest experience was at Cambridge Associates, where I was a client-facing generalist consultant. So I never really had any actual Wall Street experience. I have mainly an investment consulting or even a management consulting background prior to that. So I knew I would have to build this in a unique format, starting from scratch, and I would not have the ability to access deeper pools of capital on day one. So what I did is I decided that the unique way I would approach it was to make sure I met people in person. So I wanted to build in-person real world relationships. I did not want to rely on the internet and try to go down the path of building a presence using either blog posts or social media. At the time in 2014, social media was just getting going. Things like Twitter, X, they weren't as popular as they are today. But even if they had been, that wasn't really the approach that I wanted to take. It didn't suit my personality type. My mentality was, I'm going to go out there, build relationships. It might take 2, 3, 4 years to get people to trust me. And then if the performance is there, the business will hopefully grow. So I identified a small set of conferences where emerging managers, especially macro and futures oriented trading managers, could meet either brokers or potential end clients. And I went to 2 or 3 of those conferences every single year. And it took time, but over the course of going to 10 to 15 of those conferences over the first 3 to 4 years, I was able to build those relationships and start getting those smaller separate accounts, and was able to grow the AUM carefully over the first 4 years or so.
That's an incredible experience. And just moving on to some final thoughts, what is the best advice that you have for new managers? It's such a challenging time in the first few years, and you've been quite successful.
Yeah, the advice is going to be different based upon where the person is coming from and how much AUM they start with. But assuming that you have a sort of similar story to mine, where you're starting from scratch and maybe you don't have institutional backing, given that, I think the number one piece of advice I'd offer is just to extend your time horizon and have a lot more patience than you might think you need. When in finance, I think in tech and finance, which are the two sort of fame-oriented sectors of our economy, everybody wants to become rich overnight. And so people tend to have these 2 to 5 year time horizons from inception to when they're going to make it big. And I think that's the mistake. I think you should think of a business that you start no differently than if you're starting a clothing company, or the way that a Procter & Gamble or other large industrial companies took, 30, 40, 50 years to grow very slowly, and have that 20, 30, 40 year mindset where you might not get rich or famous, but you'll build a nice business if you have that multi-decade orientation. And that means that you need to really slow down your time horizon and realize the first 10 years are just the grind to really build out the track, get the overhead in place. You're reinvesting all of the money you make back in the business. And in fact, we have an 11-year track record. I have not made a single dime from the business yet. I've been able to compound my own money side by side with the clients, but I actually haven't taken revenue out of the company to use for living expenses or just as a paycheck. I've just been reinvesting all of our cash flow that we get from management fees back into the business. So that mindset just has to change. You have to have a very long-term mindset. And this is an insight that I also gained, I think, partly because I was older when I started the business. And one nice little thing from having worked at Cambridge Associates was I saw a lot of pedigreed folks, people who had worked at famous hedge funds, had gone to Ivy League schools, and were starting with 300 million, starting with 400 million. And they'd have a heavy overhead to begin with, and they would build a 4 or 5 year track record, and all of a sudden they would then disappear. They would write a letter saying, "We've lost our confidence in our views. We're in the deepest drawdown we've been in, and we've decided to return capital to investors." And I saw that happen probably 13, 14, 15 times over and over and over again. And I think the issue there is that because of how long your time horizon needs to be, you need to really marry your approach to, again, a multi-decade framework for not only making money, but building the business. And if you just have a sort of a quick, let's move quickly and let's take a risk approach, I don't think it's the right business to go into. There are a lot of pieces. There's a marketing element, operations, and investments, and you have to love all three legs of that stool. Otherwise, it won't work. So really just multi-decade time horizon, not a multi-year time horizon, is the number one piece of advice I'd offer people.
That's great advice, and a really important message for new managers. It does take time to build a strong business. Well, congratulations on your business and your continued success. Thank you for being here today, Asim.
Thanks.
Next, we'll move to Sumit. Sumit, as mentioned, is from NAV Consulting. NAV Consulting is often the first stop for new funds. So Sumit, can you share some of the best practices managers should aim for when setting up their funds?
Absolutely, Maureen. And Asim, great story. I mean, Asim, his fund, they use NAV for fund admin services. And I remember I met him at one of the conferences like few years back when he was, fundraising. He had a track record. So it's been a great journey. We have seen him grow over the years. So Maureen, back to your question. Yes, we do get calls from a lot of the fund managers who are looking to start their fund. And majority of the times, we are one of the first calls that, the managers make. They sometimes go to the attorneys, but we get a lot of the first phone calls. I think one of the things that managers kind of look to do as they are setting up the fund is kind of build the operational structure and deciding on the appropriate legal structure of the fund, how they should partner up with different service providers. So they have all these questions around operations, especially when they talk to us. Because they've got their track record, they know what to trade, they are all set on the trading strategy. But operations is one piece that they are not entirely sure about. One of the big pieces that they kind of look for guidance is, what jurisdiction, what legal structure they should go with setting up the fund. Um, we see fund managers go with US domiciled funds, Delaware funds. We see fund managers go with Cayman or BVI structure for more of the international investor base. So we always advise the fund managers, look at your investor base, look what your investor preferences and what regulatory framework you are comfortable with, and based on that, you decide where you want to set up the fund. Of course, it's more on the attorney's side. We do refer them to a lot of the attorneys that we closely work with, so that they can get some good advice and they can see, how to set up their fund. The next thing that they kind of look to do is to set up a solid infrastructure around the fund, which means that partnering with the right service providers. So for an example, how to select a fund administrator, what to look for in a fund administrator. How do you go out there and select audit partners, banking partners, trading partners? So there's a lot of these gaps that they need to fill, and find out the appropriate partners that you can have for your fund. So that's really important. And because we've been in the ecosystem for a long time, we have connections with a lot of the companies out there. We introduce fund managers to, audit companies, trading platforms, banking partners that they can go out and talk to them and eventually select the right partners that they need to set up for the fund, because it's really important that they have these partners, they set up their internal processes, and they focus on the transparent investor reporting.
That's really helpful guidance. As we'll hear today through the rest of the panel, finding the right partner is important to setting up for future for success. So what should managers look for when selecting a fund administrator?
Yeah, I think I would say one of the big things that you need to look when you select a fund administrator is whether you are able to scale your operations with that administrator. A lot of the times the emerging managers, they start with a few $1 million. Right off the bat, you won't get like a $500 million check, right? So you start with like 10, 20, 30, $50 million. But you do need to see, once you are at a scale where you have like $500 million in AUM or $1 billion, whether your administrator is able to support your operations at that point of time or not. Because it's always a hassle to change fund administrators. So you should see whether you are able to scale with that fund administrator as you grow in your journey. So that's number one. Number two, I would say, is whether the administrator is able to provide a comprehensive solution to you. There's of course some standard pieces in terms of services. There's fund accounting, reporting, but whether the administrator is able to provide the other services like AML, KYC on the investor, the compliance support, whether they have the required technology to support your fund structure, your trading strategy, trading style, whether the administrator is truly an independent administrator, which means that they don't rely on the fund manager to get the data. They are independently reporting to the investors, getting all the data from different counterparties. So you should see whether they provide like a comprehensive platform, comprehensive reporting. Do they offer an interactive web portal that you can, issue to your investors, whether they offer online tools to you. So there's a lot of things that you should look around. Um, I would say also look at the fact whether the administrator is able to support institutional investors when they come into the fund. So look for the pedigree of the fund administrator, whether they have dealt with larger funds, institutional investors, whether they are able to handle any prospective, investors' due diligence questionnaires if they come into the fund. So I think you need to look at all these different factors to figure out which administrator would you want to go with.
So once you've gone through all of these steps and found the right partner, what can you expect from them through the relationship?
Right. I think one of the big things that you should expect from an administrator once you've hired them is you should be free from all the operational burdens, and they should be able to kind of take that job up, right? You shouldn't have to be involved in all the operational accounting, investor related, those kind of things, and your administrator is able to take up that job, and you're more focused on the investment opportunities. So I think that's one of the biggest piece. But generally, once you hire an administrator, you can expect a transparent reporting to the investors, and independent reporting. You should expect compliance with all the regulatory standards, assuming that your administrator is also registered with the regulatory bodies. So in the US with SEC, if you're a Cayman domiciled funds, then with Cayman Islands Monetary Authority. So you should expect that all the policies, processes that the administrator is running, they comply with all the applicable laws and regulations. So you should expect that. You should also be expecting, whether the administrator is able to assist with any prospective due diligence calls. So let's say down the line, you get a big check from one of the, larger institutional investors. I would say 99% of the times, the institutional investor would like to set up a meeting with the fund administrator and just see, all the processes and procedures around the fund. So your fund administrator should be able to assist you with that. And of course, provide a scalable infrastructure, automated reporting, audit trails, and just making sure that the fund meets all the LP expectations in terms of transparency and compliance.
Great. Thank you so much for that information. There's a lot of work that goes into the very early days of setting up a fund. As Asim and Sumit have shared with us, so much of that effort goes into building out the business, the critical steps for preparing for you to find your quality investors. So with that, next we'll speak with Tracy and about how she and Exponents find managers to invest with. Exponents is unique as its goal is to find stellar early stage managers. So Tracy, how do you and your team find these funds?
You get to the point, Maureen. That is a very good question. So sourcing those stellar early stage underdiscovered manager is very important in our investment process. Now, this is also a value proposition, labor intensive value proposition on our part. Our manager sourcing is really beyond the traditional database screening. We travel a lot all over around the world. We do hundreds of phone calls each year, and we join all kinds of industry conferences. It could be emerging manager conferences. It could be capital intro events, or it's quant manager in conference, or it's value style manager conference. And we also leverage our team's deep network and experiences accumulated over the years. We got referrals from our clients, from existing managers, from our industry contacts. Sometimes it could also come from the reference firms. And we exchange notes during those reference calls. So really, and I would say nowadays I found those referrals is one of the most valuable ways for the manager resourcing. And oftentimes, I would say 90% of those referred managers do not exist in the traditional databases. And many of those investment options look nothing like we would invest in initially. For example, we met with a long-short manager, and we convinced them to carve out their long book to manage a standalone long-only portfolio for us. Or this is a global equity strategy, and we trying to see if the manager have the similar skills to manage a standalone international equity portfolio, and we carve out that portfolio for the evaluation purpose. So at the end of the day, I would say our manager sourcing is really oftentimes unconventional, creative, but that requires a lot of work to validate and evaluate those managers.
Thank you. It sounds like it's a lot of work. You're clearly a great partner to early stage managers, and your process is very thorough. So with that, what are you looking for in terms of strategies?
That's a good question. So from an investment strategy perspective, the most important thing is we like to see the manager has shown defined investment edge that we believe will persist through the long time period. So for the fundamental managers, we like them to have the skills and expertise in their investment universe. We like them to not only know the names in their portfolio, but also the entire opportunity set in their universe. We like them to be able to walk us through all the names, in any name in their portfolio or in their past portfolios. So you really can tell the depth and the breadth of the manager's research capability. For quant managers, research is the key. We like to see the managers always investing in research, talents, enhancing, adjusting their model to adapt the evolving market environment. We also like to see the managers to be consistent and stay true to their investment style through a whole market cycle in different market environments. In terms of track record, now, ideally, we like to see a manager already have over 3 to 5 years long-term standalone live portfolio track record. However, for the early stage managers, that is oftentimes a luxury. So it's not everyone can take over their track record from their previous firm. It could be a co-PM structure. It could be a different portfolio, a carve-out structure. So what we do is we, like manager sourcing, we can be creative in looking at managers' track record. We will be open to everything available on the table. It could be a carve out of a portfolio, or it could be a combination of paper portfolio with a live portfolio. But we always take those as a grain of salt because those are not standalone live portfolio. But the bottom line is we wouldn't just tell the manager, come back in 3 years, because we want to be early. So we are open to all kinds of historical track record, but more importantly, we will be closely engaging with the team to evaluate their dynamic portfolio change, like what they do this quarter versus last quarter, why you sell this name, why you buy that name, to understand their investment process.
That's very thorough. It sounds like there's a lot of hand-holding and a good, strong relationship with the managers you choose to engage with. When you do find those managers, what is your advice for their early days? What's some advice you'd give to managers in terms of building a relationship with you?
That is a good question. So speaking of the advices, I think I really appreciate Asim's story. Like his story really speaks for this question. I appreciate your patience and glad eventually it pays out. Now, very important, like set up a reasonable or more conservative expectation of the firm's growth, and also leverage technology and do the outsourcing to reduce cost. So we've just worked with so many managers. We've seen many of those started from early stage, from zero, and eventually been very successful. And many of the others are still treading water, even this is after 10 years, like Asim. They still haven't taken money out of the firm to their pocket. So many successful portfolio managers, when they left the previous firm and set up their own firm, they have a tendency to expect a rapid asset growth in the first few years because of their successful experiences in the past. However, the reality is actually very difficult, especially if you start from zero. It takes much longer time than you anticipate. It takes many more years to start to get to 100 million from zero than to get to 5 billion from 2 billion. So that is the reality. So we like manager to have a reasonable expectation on that, and also at the same time be open-minded. Be open-minded about everything. So if investors come to you to bring up something new, like to start a new strategy by leveraging the existing strategy, or to set up a separate account on top of your own fund, that might not be something in part of your original plan, but you have to be open-minded. If you look at our successful managers, I think one common thing is that many of those are very open-minded, especially in the early few years, because you cannot afford to lose any opportunity in those few years. And the other time, like in order to build up a relationship, like you are already a manager of us, we maintain this, like you are already being funded or you're on our buy list. So oftentimes, we have to construct our investment view in terms of like, for example, value versus growth, or whether to take a bet on international small cap. We like to leverage our managers' insights. We want to be able to lean on our managers sometimes. So when we throw out those requests, we don't request every manager would give us a very in-depth research, but it does stand out if a manager provides a very thoughtful piece. We wouldn't make our portfolio decision based on that, but honestly speaking, we build up our conviction to the managers based on those piece by piece, those kind of small things to understand the breadth and the depth of the manager research capability. And also that will also make the manager to be a more valuable and a better asset to our clients. So those are some of my advices to early stage or existing managers.
I think a lot of our listeners will be happy to hear they're in the similar boat, in that it does take quite a long time, maybe relative to how they thought it would go, even with great partners like you. So it's really helpful to set the stage. So moving on now to once a new fund has an investment with you guys, they get on the platform, they get in a portfolio. What happens as they grow beyond either the tenure or the assets of how you defined an emerging manager?
Yeah, so once a year or once to a few years, you will see that successful stories. Those managers that has been very successful and growing to beyond what we could invest in. So in that situation, we would recommend to graduate the manager from our platform and that them directly invested by our clients. So we call it graduation. So there's no like a specific number of AUM. It's sometimes depending on the specific clients, specific mandates. But by and large, we would recommend if the manager is too large, they need to graduate from our platform, and we will shift our focus. And we actually always been doing that to find the next generation under-discovered early stage managers. Yeah.
Thank you, Tracy, for that. It's great to hear there's an appetite for emerging managers and that your firm not only provides discovery, but a path for funds to grow their firm well beyond the early stages with institutional quality investors. Okay, on to what is perhaps the most daunting part of the launch cycle for new managers. Admis is here to share insights that will hopefully put you at ease when it comes to what to expect for your first operational due diligence on site. First is that ODD will not be your first meeting with an investor or a consultant, but many it's the final step before approval. So Admis, what is your advice to emerging managers when it comes to preparing for an ODD meeting?
Right. So I can actually share a recent example of a commission that I worked on where our client was the seed investor and wanted us to do ODD on a new manager pre-launch. Initially, there was just the CIO, slash PM in place. And so when I spoke to the PM, there was no operations staff in place. There were no policies in place. It was so early that there was really nothing for me to assess from an operational perspective, right? So what I asked is once they hired a operations person, which they were planning to do and in the process of, I said, reach out back to me, in a couple of months once that, that person is in place, because there was nothing there at that stage. And so then they hired a COO, and then the COO reached out to me. And then the next step was discussing a timeline in terms of, what key service providers have they engaged, and if certain key documents would be ready. And so I can speak to in terms of service providers that are that we'd like to see engaged. I mean, Sumit mentioned administrator. I mean, third-party administrator, I think is, obviously high on that list. Typically, they've already engaged some sort of external legal counsel to assist them with the structuring of the fund and the offering documents. They, depending on what type of operations or finance person you have in-house, which we typically would like to see at least one person in that position, it's usually a CFO slash COO type of role. However, we also see, in this case, it was a COO who then they use an outsourced CFO. Sometimes we see also a outsourced, someone who is a CFO, but also has an outsourced middle back office provider to help supplement internal resources. We see compliance consultants in place, as well as IT service providers. And so these service providers are going to assist the manager in setting up some of the key documents they'll need, and that we'd like to see a few of them, which I'm going to list next, in place so that we have something to review and assess, right? And so fund offering documents would be, key thing in order for us to review the fund terms, a code of ethics slash compliance manual, a valuation policy, and then a information security policy and a business continuity plan and disaster recovery plan. Typically if it's pre-launch, there's not going to be any audited financial statements, and so we ask them for estimated fund operating expenses at that stage. And if you're a hedge fund, we may ask for a trade cycle or flow chart to better understand the trade process. And then lastly, I would just say with systems, they don't necessarily have to be in place before the ODD meeting, but I think having a sense of which systems you're considering and planning to implement will be something that we can take a look at, because typically a lot of the well-known systems are if we know that you're going to be using an OMS that's pretty standard, then I think it gives us a sense of what's to come. So I would say those are the key areas that essentially in terms of preparing for an ODD meeting that you would want to have under your belt before ODD is done. Otherwise, it may be too early. And I think you want to make sure you have something in place. And then that way we can also give a roadmap to certain improvements you can make on those things.
That's really helpful. And Allborn, like many other consultants, their ODD process is the same, whether you're an established manager or an emerging manager. But there are certain key risk areas that are more particular to funds that are under 250 million. What are those risks, and how do they focus on those?
Right. So for the purposes of our conversation, I've filtered our risk data to come up with 4 risk areas in order to for managers under 250 million, as you said. And so I'll just mention though that I've excluded business stability risk from this list, only because we deem that as an inherent risk. And so I want to focus on areas today that have more actionable recommendations and pointers. So to start off with information security and cybersecurity risk, this is actually something that, based on our review of our data in the last 5 years, is actually a top ODD risk amongst hedge funds, private market funds, AUMs of all sizes. So it's not just an emerging manager issue. I think positively, though, I will say that for emerging managers, gone are the days where you would have to invest thousands of dollars in physical IT hardware or servers that you need to manage, whereas now things have moved to a fully cloud-based infrastructure, and so it's made it easier for startups to get on a fully cloud platform such as Microsoft. And within information security risk and cybersecurity risk, I wanted to just highlight about 5 or so specific key areas that emerging managers should implement. The first one is around user awareness and training, and so ensuring that staff have appropriate training on cybersecurity risks, what to look out for. Another way that we recommend doing this is through phishing testing, which we recommend be done on a quarterly basis. The next one is around multi-factor authentication. You want to ensure that you want to reduce the risk of any type of unauthorized access, and so MFA is pretty common and standard now. And a third area here is we look at least functionality, and we also look at the ensuring that employees are not able to download unauthorized applications, whether that's on firm-approved laptops or firm-issued mobile devices. A fourth area that we look at is whether or not portable media devices are restricted. Typically, we recommend that you disable them. However, if you are going to allow them, that you only limit it to certain necessary individuals, and then if they are going to use them, that they be encrypted. And then access controls is another area, just to make sure that you're giving privilege and access to the right individuals, I should say. And in terms of admin rights, it would be who has the admin rights, and making sure that if it is going to be someone internally, in addition to, say, your IT service provider, that there's a segregation between their day-to-day user account as well as their administrator account, so that if they're both the same. If it gets breached, that there isn't going to be a bigger issue if the administrator account gets breached. And then lastly, I will say, being a small manager with no self-managed services, which is what we typically see, is to have a cloud configuration review done, which would look at identifying any gaps, any misconfigurations or vulnerabilities in your cloud setup. So that summarizes information security risk. Next area, common risk area amongst emerging managers is segregation of duties. As we all know, as emerging managers typically have limited internal resources, and so using the service providers that I mentioned earlier to help supplement internal resources is key. The third risk area is around cash controls, and this closely ties with segregation of duties. And this is where we suggest that you leverage your third-party administrator to use their treasury function to be able to assist you in approving or releasing third-party cash expenses. Ideally, you want to make sure that it's someone in the back office along with the third-party administrator that are involved in the releasing cash payments, are involved in establishing good strong cash controls. And then lastly, I would say around compliance. Typically, as an emerging manager, you may be an exempt reporting advisor, and so there's less requirements from a compliance perspective. You don't have to have a designated CCO. However, you do have to have certain compliance policies in place, and those include insider trading, which includes material non-public information. Anti-money laundering is another area. And then pay-to-play rules, which you want to incorporate gifts and entertainment policies within that. And so what you're going to find is that, I would say maybe on day one, you may not necessarily you be an ERA potentially, but as you get closer and you start to attract more capital, I would say that you would probably want to even consider implementing registered investment advisor best practices, because I think that would help you attract institutional investors, right? Because you're implementing best practice compliance policies and procedures. And then within that, I would say, while ERAs are not required to do compliance testing and surveillance, you do want to adopt some level of pre and post investment testing and email review as a matter of best practice.
Great, thank you. There are a lot of things to keep in mind ahead of these ODD meetings. So that's very helpful insights and very specific. So I'm sure our listeners will appreciate, we'll be writing these down. Beyond those key risks, what are some of the pitfalls you may see new managers struggle with, and what should they do to overcome those or avoid them?
Right. So I would say, firstly, that disclaimer to the emerging managers listening to this: the ODD process may feel very invasive, but transparency, I would say, is very important. If you're looking to attract capital and you want investors to trust you, you want to be as transparent as possible. We do generally find emerging managers to be very transparent, but occasionally you may find you may come across those that aren't. I think this is a cue for investors of things to come. If a manager is not going to be transparent before investing capital, then once the check clears, I guess it might give you a sense of what's to come down the road. We are going to ask about things like break-even AUM and management company expenses to better understand whether or not there are going to be, typically there will be operational shortfalls at that point, and so who's going to cover those expenses? Is the PM paying themselves a salary, for example? And so these are all questions we get into the weeds of. The other thing I would say is, as it relates to the ODD meeting itself, is just not to impose any type of unrealistic time constraints on the ODD meeting. we do go through materials before the meeting, but we go in depth, and so the meetings tend to be, could be 3 to 4 hours long. And then you also want to make sure you have the right people in the room. Oftentimes with emerging managers, they typically have some of their service providers attend parts of the ODD meeting. So if there's an outsourced CFO, for example, they would attend the ODD meeting, as well as a IT service provider to discuss certain topics. And then the last one I would say is around background checks. When clients do commission them, we do a pretty thorough background check. And so I think whatever you are marketing yourself as in your marketing materials, if you say that you've graduated from a specific university and use that language, but actually, you were 2 credits short and didn't actually graduate from that university, then do not put that in there. So you want to be, as honest as possible and transparent as possible, because, thorough background checks will be performed.
That is great advice, and much of that advice is applicable whether you're emerging or established. So thank you for sharing that information with us, Admis.
You're welcome. Thank you.
Having been a consultant and a fundraiser myself, my best advice to funds is to use the ODD sessions as your own consulting meeting. You can ask questions on what is industry best practice and what you need to do to get there. Many consultants like Allborn will also provide feedback after the meeting. So you will have some guidance on what your next steps should be to keep improving your firm operationally. So ODD meetings should be arranged with a list of topics that the manager will send around beforehand, as Admis had mentioned, and they do a lot of work before the meeting as well on their own. But I would also encourage our listeners to reach out to other industry partners who provide guidance to managers. For example, Amos shares their hedge fund, their standard hedge fund DDQ with their members. It also has templates for unique strategies like digital assets, corporate lending, and a broader private markets guide. The SBAI has a manager toolkit as a dedicated page to small and emerging manager resources. And ILPA has an emerging managers toolbox on their website. And they also host an emerging manager showcase each year where they provide access to LPs. This brings us to the end of our webcast. I want to thank NAV Consulting for hosting this informative panel. They're a fabulous resource for getting started in your fund's first days. I also want to thank our panelists, Awesome, Sumit, Tracy, and Admis, for sharing their insights on what it takes to navigate each part of the emerging manager process. And a special thank you to 100 Women in Finances, Rahana and Sarah Finley, for putting together a great group of thoughtful experts. It's been a pleasure speaking with you all today. Thank you.